You weren't supposed to see this price. You weren't supposed to question why gold is hovering near 5,074 while the dollar surges, why silver is pressing against 84 like it's testing a locked door, or why the market feels calm on the surface but tense underneath. Because when gold moves like this, it's not just a price chart, it's a signal. And signals like this usually show up before something bigger shifts. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Gold is sitting at 5,076 after dipping to an intraday low near 5,045. On paper, the explanation is simple. The US added 130,000 jobs in January. Unemployment eased to 4.3%. Wages held steady at 3.7%. The dollar strengthened. Traders reduced expectations of a Federal Reserve rate cut in March. End of story. That's what they want you to believe. But markets are never that simple, because gold doesn't just react to jobs data. Gold reacts to power. When the Nonfarm Payroll report came in strong, it gave the dollar a short-term boost. Strong labor market, stable wages, lower urgency for rate cuts. The narrative was clean and controlled, the kind of narrative that reassures retail investors, the kind that keeps people in stocks, the kind that makes you feel like the system is stable. But here's the part that matters. Gold didn't collapse, it pulled back, it hesitated, it edged lower, but it held above 5,000, and that tells you something far more important than the headlines. When an asset refuses to fall hard on supposedly bearish news, it means there are buyers you can't see. Institutions don't chase headlines, they position before them. And when gold bounced off 4,996 and held that upward trend line from the early February low near 45,940, that wasn't retail panic buying. That was structured accumulation. Look at the 4-hour chart. Gold is trading sideways near 5,074. The 0.618 Fibonacci retracement sits at 5,138. That's the first resistance. Above that, 5,303 becomes the next target. The 50-period moving average is flattening around 5,000. The 200-period moving average remains below 4,800, keeping the broader trend tilted upward. Small-bodied candles, mixed wicks, consolidation after a sharp rebound. To most traders, that means indecision. To professionals, that means compression. And compression in financial markets is like a spring being wound tighter and tighter. The longer it coils, the more violent the release. The jobs, data strengthened the dollar. But ongoing concerns about the Federal Reserve's independence are quietly capping that strength. That's not noise. That's structural tension. When faith in a central bank's independence starts to erode, even slightly, gold becomes more than a trade. It becomes insurance. Beth Hammock from the Cleveland Fed says inflation needs to return to 2%. Jeffrey Schmid from the Kansas City Fed warns that cutting rates too soon could keep inflation high. Their language is cautious, controlled, deliberate. But here's what they don't say. Inflation isn't just a number. It's a slow tax on everyone holding currency. Currency debasement doesn't happen overnight. It happens quietly, gradually, in percentages that feel small but compound into something devastating over time. And gold exists outside that system. It can't be printed. It can't be diluted with keystrokes. So when gold hovers near 5,074 under dollar pressure and still refuses to break below 4,996, you have to ask yourself who is buying and why. Because retail investors are not confident right now. They're cautious. They're waiting for Friday's consumer inflation report. They're waiting for confirmation. They're waiting for permission. Institutions don't wait for permission. They accumulate into uncertainty. The trade idea floating around is simple. Go long above 5,040. Target 5,300. Stop below 4,095. Clean, mechanical, technical. But beneath that clean structure is a psychological battlefield. Most people think markets are driven by data. They're not. They're driven by fear and greed wrapped around data. Fear of missing out pushes late buyers into breakouts. Fear of loss pushes weak hands out during pullbacks. And whales, the large institutions and funds with deep liquidity, understand this better than anyone. They create liquidity traps. They push price toward obvious levels. They let retail pile in. Then they reverse it, not because they're evil, but because they need liquidity to move size. Gold above 5,140 becomes a magnet. If it breaks and holds, momentum traders jump in. Stops trigger, short positions unwind, price accelerates toward 5,300. That's how asset repricing cycles begin. Slowly, then suddenly. But if it fails and drops below 4,996, the narrative shifts. Confidence cracks, retail panic increases, the drop toward 4,055 becomes possible, and in that fear, someone else accumulates. That's the game. Now look at silver. On the 4-hour chart, silver is trading around 83.75. It's pressing against the 200-period moving average near 84. After bouncing from a low of 70.37, it's making higher lows. That typically signals recovery. Slow, methodical, structured. But the candlesticks near 84 have small bodies and upper wicks. Indecision, rejection, pressure. The 50-period moving average is still sloping downward. Short-term pressure remains. Horizontal support sits at 79.81. RSI is hovering near the midline. Balanced momentum. In simple terms, silver is coiling under resistance. Above 84.25, the path opens toward 88.00 and potentially 92.14. Below the rising trend line, a pullback towards 79.80 becomes likely. The trade idea is clear. Consider long above 84.30 targeting 88.00 with a stop below 81.80. But again, this isn't just about price levels. Silver is more volatile than gold. It reacts harder, moves faster, and because of that, it's often used as a leverage play during precious metal cycles. When institutions believe a broader repricing is coming, silver tends to amplify it. Here's where the psychology becomes dangerous. Retail investors look at a strong jobs report and think the economy is healthy. They see stable unemployment at 4.3%. They hear officials talk about holding rates steady. They interpret that as stability. But stability in macro markets is often the calm before a policy shift. When traders see a high probability that the Fed will keep rates unchanged in March, they assume predictability. Predictability lowers fear. Lower fear pushes capital into risk assets. Stocks rally. Crypto rallies. The herd relaxes. And while the herd relaxes, gold quietly builds a base above 5,000. That's not random. Gold doesn't just reflect inflation. It reflects trust. Trust in currency, trust in policy, trust in institutions. When whispers about central bank independence start circulating, even subtly, large capital reallocates. Not loudly, not dramatically, quietly. This is how silent wealth transfers begin. Money moves from overvalued paper assets into hard assets, from speculative bubbles into defensive stores of value, from crowded trades into underowned ones, and most people don't notice until the breakout is already halfway complete. Think about the 0.618 Fibonacci at 5,138. That's not just a technical line. It's a psychological checkpoint. If gold clears that level decisively, it signals strength against both the dollar and policy uncertainty. A move toward 5,300 isn't just a number, it's a statement. It says the market no longer fully trusts the current monetary narrative. And silver above 84.25 would echo that message. It would signal that the precious metals complex is waking up. But here's the twist most people miss. A strong jobs report and delayed rate cuts don't eliminate inflation risk. They extend it. If rates stay higher for longer while inflation remains sticky, pressure builds under the surface. Debt servicing costs rise. Governments borrow more. Fiscal deficits expand. Eventually, something has to give. And when it does, the repricing is rarely polite. Liquidity cycles move in waves. First, central banks tighten. Liquidity drains. Risk assets struggle. Then stress appears. Policy shifts. Liquidity returns. And assets tied to real value surge. Gold and silver are not just commodities. They're thermometers for monetary stress. Right now, the thermometer is not screaming. But it's not cold either. It's hovering, waiting. The small-bodied candles on gold and silver aren't weakness. They're hesitation before commitment. And hesitation is where positioning happens. The media will focus on Friday's consumer inflation report. They'll frame it as the next big catalyst. If inflation comes in hot, fear returns. If it cools, optimism spikes. Either way, volatility increases. But volatility is opportunity for those already positioned. Retail traders react. Institutions anticipate. That's the psychological divide. You are conditioned to wait for confirmation, to wait for headlines, to wait for analysts. By the time confirmation arrives, price has already moved. When gold bounced off 4,996, that was not a coincidence. It aligned with the upward trend line from 4,540. It aligned with structural support. It aligned with institutional footprints. The flattening 50-period moving average around 5,000 shows equilibrium. The 200-period below 4,800 confirms broader bullish bias. The structure is not broken, it's compressing. And compression at these levels in this macro environment with this much policy uncertainty is not something to ignore. This is where fear and greed begin to wrestle inside the human mind. Fear says the dollar is strong, stay away from gold. Greed says if gold breaks 5,040, jump in before it's too late. Both emotions can be exploited. The key is understanding that markets are engineered around human reaction. When everyone expects a breakout, false breakouts become profitable for large players. When everyone expects a breakdown, squeezes become explosive. So the real question isn't just whether gold can clear 5,140 toward 5,300, it's who needs it to. If institutions are positioning for a longer-term shift in monetary policy, they will accumulate quietly under resistance. They will allow price to test it repeatedly. They will let retail get bored. They will shake out weak hands. Then, when liquidity aligns, they will push. And the move will look sudden, unexpected, inevitable in hindsight. Silver's structure mirrors this tension. Higher lows since 70.37, pressure against 84, balanced RSI, short-term resistance. It's not explosive yet, but it's building energy. In financial markets, energy stored in consolidation often releases with force. And when both gold and silver align technically and psychologically, the move can cascade across asset classes. Crypto whales watch this. Institutional funds watch this. Macro hedge funds watch this. Because precious metals moving decisively often signals a broader shift in risk perception. It signals that smart money is hedging. And hedging is rarely done at random. So here's the warning. Do not mistake short-term dollar strength for long-term currency supremacy. Do not mistake calm charts for safety. Do not assume that because gold is hovering, nothing is happening. Something is happening. It's subtle, it's slow, it's structural. Gold above 5,000 is not weakness. It's resilience. Silver pressing against 84 is not failure. It's testing. If gold breaks above 5,140 with conviction, the path toward 5,300 opens. If silver clears 84.30, momentum toward 88.0 becomes likely. But if supports fail, downside toward 4,055 in gold or 79.80 in silver becomes real. Either scenario creates volatility, and volatility transfers wealth from the unprepared to the prepared. The human mind is the real battlefield here. The numbers are just weapons. Fear will tell you to freeze. Greed will tell you to chase. Media will tell you a story that feels complete but leaves out the motive. Your job is to see the structure beneath the story. Gold is holding above 5,000 despite strong jobs data. Silver is compressing under resistance. The Fed is cautious. Inflation data looms. Central bank independence questions linger. This is not random noise. This is a setup. A setup for either a breakout that redefines near-term price expectations or a shakeout that clears weak positioning before the real move. Most people will see the outcome. Very few will understand the process. And the process is where power lives. So ask yourself this. If gold clears 5,140 and runs toward 5,300, will you believe it too late? If silver breaks 84 and accelerates, will you chase it at 88? Or will you recognize that the signals were here, hiding in plain sight? Because this isn't just about metals, it's about trust, it's about currency, it's about who controls liquidity and who reacts to it. And in a world of expanding debt, persistent inflation pressure, and fragile confidence, hard assets don't just sit quietly forever. They wait, then they move. The question is not whether gold and silver can break higher. The question is whether you understand why they might. So tell me in the comments, do you think gold clears 5,040 and runs toward 5,300, or does it fake out and trap the crowd first? Send this to someone who needs to hear it. And if you want to stay ahead of the silent shifts before they become headlines, subscribe now and turn on notifications because the next move won't wait for you to be ready.